The Money Show.
Personal Finance with Warren Ingram.
Warren, of course, is a certified financial planner at Galileo Capital. And Warren Ingram, good evening to you. Good to talk to you, even though it is a public holiday. Tonight, you've decided to talk about inflation and your retirement. And I suppose when you consider all of the conversation we've had about inflation and about interest rates over the last couple of weeks, it's a very good time to talk about it.
I agree, Stephen. I think it's one of those things where, we've all been bitten by the inflation problem over the last couple of years. And, now that it's going to start easing off, I know it doesn't feel like that for a lot of people because, inflation, it kind of bites and then it stays there. It doesn't leave you. It just means that costs don't keep increasing in the months or years ahead. But now that we've got this issue and it should start to dissipate and kind of ease off over time, what we want to know is how do we protect ourselves against this biting us again in the future? Because one thing we have to know is there is nothing we can do to control the rate of food going up or the rate of fuel going up and all of those kinds of costs that eventually will impact our day-to-day cost of living. And so we need to know that it's a reality and we need to know that it moves in very big cycles. And then what we need to do is figure out how on earth do we protect ourselves so that we can deal with all of these big cycles as they come and go.
I mean, I suppose one of the things also is you don't know what kind of era you'll be living through. I mean, there was a time not long ago, 25 years ago, 30 years ago, when inflation was much higher than it is now. And it had been very high, if you go back to sort of the 1980s, for a very long time. Then it went low, then it, after the pandemic, went up again. And you don't know what you're going to live through.
Exactly right. Yeah, I think we're dating ourselves, Stephen. But if you go to the late 70s, early 80s, there were times when cost of living was going up, way more than 10%, probably 15%. Prime interest rates were around about 25%. I mean, you just think about that. 25% on your home loan means that your bond was probably doubling every 3 years, and that's an almost impossible thing to try and deal with. So you need to know that if you're living with inflation for the first time as an adult now, welcome to the club. It's going to go up and down a lot over your career, and if you're older, just understanding that cost of living is high for a lot of people, but unfortunately, things like global conflicts will cause inflation again, and so it might not just be the recovery from a pandemic. It could be many reasons why we're in this inflation issue, and the only thing that that reserve banks can really do to control inflation is use interest rates, and that's what they've done. And I'm not going to tempt fate. It looks like they might have beaten the inflation bug this time around, but it is a sticky thing. It does stay with us for quite some time, and that's the thing we need to understand is there will be times when we're paying a change in our cost of living going up at 6% a year. And, as we've seen recently, it could be as high as 10% a year for a few years at a time. And that's really devastating for a lot of people.
Okay, so what can you do about it? You have to live through this environment. You have to be on a fixed income in later life. How do you protect yourself? What do you do?
So I think I probably want to answer it in two ways. One is to the people that are working, and then to those that that are retired. And so for working people, the hope is that over time our salaries, our incomes tend to track inflation. I'm not saying that it always works exactly like that, but if you look at the wage negotiations that get discussed in the press and you look around the world, it does tend to work in that way, that your salary should eventually match the cost of living. But you want to get ahead of that. So I think always be very aware of the mix of the expenses that you have. So just understanding that sometimes the kind of more luxury items that you have when in your expense base, I should say, when those when times are tough and the cost of living is shooting up, then perhaps you want to scale back on the luxuries, delay your replacement car purchases. Maybe if you're planning a big holiday, maybe just go on a much more local holiday and then delay the big holiday for later. And so just adjust your expenses to make sure that you can tolerate those big jumps in your cost of living, because you have the flexibility, and hopefully in the 1 or 2 years after the big inflation jumps, your salary adjusts, and then by all means, reset your cost of living again, and do the things that you enjoy. It shouldn't all be about struggle and suffering. It should be about saving for the long term and enjoying life as you go. So I think for people that are working, it's a case of just get the balance right, and be very on top of how your expenses work. And if you can cut expenses when cost of living go up, that's great. I fully understand, because we get the feedback from people to the show saying that I can't cut anymore. Please stop telling me to cut. And by all means, I understand that. But then you might need to do some kind of a side hustle, to kind of earn a bit of extra money as you go. But I think, Stephen, for the retirees, it's a different psychology and a totally different mindset. If you talk to retirees, just maybe in the year before retirement and maybe the year after, they're so afraid of losing the precious capital that they've built up over their careers, that they tend to often be very conservative with their investment decisions. And what I mean is that they tend to allocate a lot more money to cash, a lot more money to what they would perceive to be very low risk investments, in the hope that they can protect the capital that they've got. And I understand the logic. I mean, I can see the motivation, but I think it's possibly the most risky decision that retirees will ever make in their lives is actually taking all of the ability for their money to grow off the table and allocating it to things that are certain, that are low risk, and understanding that certain investments, and what I mean by certain is you can lock your money in a government bond or in a fixed deposit, and you are certain to get an interest rate of 8% or 7.5% or whatever. And that certainty is really comforting, from a psychological point of view. That's, it's really great. But what you're missing out on is your capital is unfortunately not going to keep pace with the inflation problem. It's not going to keep pace with the cost of living increases that you'll experience. And so going for certainty, going for stability, avoiding the volatility of stock markets feels like a great decision. And it's actually exposing you to the silent killer of inflation. And so the big thing I would say to retirees is you actually have to invest as if you are going to have money and need money for 30, 40 years. And that means you need a large exposure to the stock market, both local market and global market. But at the very least, somewhere around 40%. And I would think that's probably the lowest level. I'm never comfortable if people only do that. I think it should be kind of in that 66 to 75% level, which is what pension funds are allowed to do. And that would be a great call, Stephen, to do that rather than go for certainty.
I mean, you talk about stock markets being the biggest inflation protection. I mean, that's quite a big thing to say, but I imagine the historical evidence shows that you are correct, and very correct.
Yeah. Yeah, it's not just my opinion, although that's definitely my view. It is the biggest inflation protection you can get. History shows you that if you invest in the stock market, it will generate returns in, let's say, in the US of about 5.5% more than inflation. And in South Africa, actually even better, it will be somewhere around 6.5% above inflation, and sometimes more than that. And just to think about that, so I know, we'll be talking on this show. There'll be a day where we'll be talking about the stock markets have crashed and there's blood on the streets, and there might be a year when we see the stock market down 30%. But what we need to know is that over long periods of time, the stock market has a fantastic track record of beating inflation. And it does it by so much that actually, all of the bumps that we see along the way become irrelevant, provided you stay invested and provided you remain patient. And that's the problem for retirees, is that it's such a traumatic emotional experience the first time you have a big crash, a market crash, when you're now retired, that it often forces them to make emotional decisions, jumping out of the market at the worst time, or just never investing in the market. And so they miss out on this massive engine of growth. And just to give you an idea, the cash market, investing in a money market will probably beat inflation by 1% a year. Now, that might sound like a great return, but don't forget there is this T word that kicks into play here. You are going to pay tax on the interest that you earn. And if you pay 20 or 30% tax and maybe more, you could be way below inflation by the time you've got your after-tax returns. So unfortunately, we all need some cash in our portfolios, but we definitely, absolutely need a decent exposure to the stock market.
I mean, there's so many things to it. And I mean, that you talk about the sort of safety and the fear. And isn't that why some products are so popular? Simply because all they do is bet on the entire stock market. They're not allocating money to parts of it or certain shares. They're literally making a bet on the entire stock market. When you do that, you're really making a bet on the future of the entire economy.
Exactly right. So I think, just understanding when you're investing in shares, there will be, in a year, there will probably be stories about a company that that blows up. Its share price implodes to zero, and shareholders lose all their money. At the same time, there'll be a story about a company that's doubled or trebled in value. I mean, we only need to think about Nvidia at the moment in the States to get a great example. But if you just look at the South African stock market, with all the nonsense we've had in our economy and all the politics and all, COVID, all of those things, very big issues. The South African stock market over 5 years is delivering way more than 10% a year. I think, off the top of my head, it's around about 12 or 13% per year for the last 5 years. Now, if we'd sat back in the middle of the pandemic and I'd said to you, don't worry, everything's going to be fine. You're going to see 12, 15, 17% returns from the JSE over the next year or two, I probably would have been sent to the insane asylum. But that's the point, is buying a large, broadly diversified portfolio of shares makes all the sense in the world, because something's going to blow up, something's going to do incredibly well, but you'll get all of that. And I think, very often you can do that through an index, just buying a diversified index in the market, or you buy, general equity unit trust. And there are lots of unit trusts that, that will give you that very broad exposure. Please don't go and allocate all your money to one or two shares because some guy on the radio just mentioned a share name. That's not the way this works.
We're talking to Warren Ingram. He's a certified financial planner at Galileo Capital. Your questions for Warren about dealing with inflation, 011 883 0702 and 021 446 0567. Also a question from Hans tonight. He's asking Warren, I see the rand is getting stronger again. Should I bring money back from overseas? Could this be a great time to invest in SA? Hans will have an answer for you in a couple of minutes.
The Money Show. Personal Finance with Warren Ingram.
And of course, Warren Ingram's a certified financial planner. And there's a question from Hans saying, Warren, I see the rand is getting stronger again. Should I bring money back from overseas? Could this be a good time to invest in SA? And Warren, actually, it's a question that kind of captures the sentiment of the moment.
It's such a brilliant question. Now, and I'm smiling when I hear you talk, asking the question, because I think, a couple of years ago, again, this would have been, the exact opposite question. People would have been saying, I just see the rand never get stronger. It's falling out of bed. We need to send all our money out. Should I send it now? What's going to happen? And particularly just before the election, this was a real question on people's minds. So I think for Hansen, the answer is you've got to make an allocation to overseas that's based on your financial position and based on your circumstances. Don't base it on a prediction or a forecast of what you think is going to happen in the world or in the currency or in the country. So in other words, if you've got no overseas exposure with your investments, then it does make sense to allocate some of your money overseas. I think at a minimum we should probably have about 25% of our investments overseas. However, if you've got enough money that you're going to leave some money behind to your children on your death, then perhaps you want to increase that to around 50%. And if you're going to, if you've got Elon Musk money, then you probably want to allocate about 75% of your investments overseas. And the reason for that is that when you're investing for grandchildren that are possibly not even born yet, you're doing it with a time horizon of 75 to 100 years. And when you do that, you really need to have a large portion of your money allocated right across the globe. It's not a comment on South Africa. It's simple diversification. So I think when if Hans is looking at having money overseas and deciding to bring some back, if he's doing it because he's over allocated to international investments, then maybe he needs to wait until the rand weakens again. But I certainly wouldn't be bringing money back in the hopes of trading a position. I think the JSE is probably going to do very well. I'm extremely hopeful that South Africa, both from an economy point of view and a stock market point of view, will be very rewarding. But things could go wrong tomorrow, and things that we would never forecast. So rather be strategic in your allocation and don't trade on big decisions like this. We're private investors. We're not big banks or big hedge funds where we can do rapid trading with big trading desks. These are really quick decisions that you'd have to make.
It's a fascinating question actually at the moment. You talk about diversification, and that's also one of your strategies for dealing with inflation. You need to diversify your sources of growth.
Exactly right. So I mean, I've spoken about the stock market being a great place to grow your money, and it's certainly your best bet against inflation. But please don't go and take all of your retirement money now and allocate it to the stock market. That also doesn't make sense. And the reason for that is we are going to be living off some of our money when we're retired, and we want some form of stability from our capital, in the way that it generates an income. In other words, you want to have some money allocated to cash because cash is going to give you an interest rate, and hopefully you get paid that interest every month. And you need to allocate some money to corporate and government bonds because they also pay interest, whether it be quarterly or 6 monthly. And then you get property companies that trade on the stock exchange that they pay out, they're taxable, but they do pay out dividends, and those dividends probably also get paid quarterly as well. So you're getting a nice source of income from those assets, and yes, they won't be your best protection against inflation, but that's why you have the stock market portion. So I would say make sure that you've got a good exposure to the stock market, as well as then allocating some money to cash, bonds, and property companies. And equally, you have to make sure that you've got an allocation to those assets, including stock market assets in South Africa and overseas, so that you're always getting some money exposed to growth sectors and some money that might not be doing so well. And diversification helps you so much because you never have to be right all the time. If you're a little bit wrong and maybe South Africa didn't work out so well and overseas did, having exposure to overseas works well. And if SA absolutely delivers in the next 5 years, then you'll be really happy that you've got SA assets as well.
And then avoiding the big risks. And I mean, this seems obvious, but so many people, and you hear it time and time again, so many retirees lose so much of their money.
There are, especially when you retire and you're a little bit underfunded. So you know that you just don't have enough money. So you've got capital, but it's not going to generate all the income you need over your lifetime. People in that position are often tempted to try and get their capital to grow a little bit faster than the norm. And maybe they decide that they're going to do one of two things. Either they're going to, let's say they were educators or nurses or somebody like that, and all of a sudden, because they like coffee, they're now going to open up a coffee shop, and that's no disrespect to people that do that, but gee, when you take your retirement capital and you allocate a large chunk of that to a business that you don't understand other than being a coffee drinker, that's really risky, and people do that time and time again. Or, their adult kids come along and say, I've got a great idea for a business. I need you to cash in your retirement fund and lend it to me, and I'll give it back to you with 3 times more money in 5 years' time. That's not a good idea, unless your kids are phenomenal business people with a great track record of doing very well in business already, in which case they don't need your money, then please don't lend them your money, because that's the thing that's going to feed you for the rest of your life. Your kids need to find their own way if they're adults. So I think that those are big issues. And then lastly, avoid then when you're at a dinner party or at a braai or at a golf course or at the bowls club or whatever it is in your walking club, and your friend tells you about this investment that's just delivering 1% a month or 2% a month, month after month, year after year, and it's never goes down and only goes up, I think you need to find new friends, because what they're telling you about is a scam. Things that only ever go up are called Ponzi schemes or investment scams. There is nothing in the world that does incredibly well month after month, year after year, forever. If there was, people wouldn't sell those investments and they wouldn't tell anybody about it. They would just do it for themselves.
And this is the entire stock market, of course, over time.
Well, the thing about the entire stock market, Stephen, is it definitely goes down, regularly. So that's the thing is, high quality investments that are transparent. What you will know about them is that they'll go up and they'll go down, and over time they'll deliver good returns. But there will be months or even 2 or 3 year periods where the investments will go down, and that's what makes investing in high quality transparent investments so difficult, is because they are volatile. The only thing that's reliable, that is safe, that goes up month after month would be a fixed deposit, and as we discussed already, those aren't going to give you inflation protection.
Warren Ingram, as always, thank you so much. Certified financial planner at Galileo Capital.